we're going to get to a point, I think, in the next probably 5 to 10 years where it is ubiquitous. I mentioned in my talk that tokenization is a freight train. It can't be stopped. And I think eventually it'll eat the whole global financial system.
Yeah. First, I want to applaud the SEC commissioner for getting on top of this issue about why we have shrinking capital markets, public markets. So we've gone from 8,000 public companies in 1996 to 4,000 today. I'm not against private credit or anything like that, but a lot of things are moving out of the banking system. We got to look at what we did. We overdid it with rules, regulations, ISS and Glass Lewis, and it damaged some of the vibrancy of our capital markets. We still have the best in the world. And so now if you look at our capital markets, it's been adopting technology nonstop. I mean, for years, mainframes, processing, algorithms, cost virtually nothing to process trades. We moved $16 trillion the other day. In one day, $16 trillion.
This isn't really a story about crypto news or innovation news or faster payments or faster rails. This is really the reset of money as we know it, and of who controls money, more importantly. Because for most people, money just means one thing. If it's earned, it's mine, and that makes perfect sense, right? But the system has been quietly replacing that idea for decades, because first they replaced money with currency, then they replaced ownership with paper claims, and now they're replacing cash with programmable assets. And once money becomes programmable, the game changes entirely.
Can you go into digital assets and sort of this trend toward tokenization and how that plays into the business model a bit?
Yeah, sure, Carl. It's a really important trend. It's one of the mega trends. We identified a series of mega trends about a year ago, and we said we want to position our business, invest in those capabilities that will allow us to benefit from those mega trends. Because while we want to drive and are driving organic growth, we also want to make sure that we're attaching ourselves to these big market cycles.
In a programmable monetary system, money doesn't just move with the freedom that we're used to. It can approve money, it can delay money, it can block money, it can expedite money. Tokenization plus custody plus settlement rails equals programmable money and programmable financial life. Your life, my life. Now I'm going to show you why this actually matters, why the banks are doing it, and how it changes the meaning of what your money truly is. Because there's a headline that should absolutely stop you. One of the biggest custodial banks on earth, BNY Mellon, is offering tokenized deposits to institutional clients. Let me translate that into normal language. A custody giant that sits in the plumbing of the global financial system is saying, we're going to put deposit money on tokenized rails. Now, why would they do that? Why would they bother ever doing that and think of that kind of machination?
But the most importantly thing, we can customize strategies through tokenization that fits every individual. We would have instantaneous settlement. Think about all the costs of settling bonds and stocks. But if you had a tokenization, everything would be immediate because it's just a line item. And so we believe this is a technological transformation for financial assets. I believe if you want to talk about voting and voting choice and all the things, if we know every moment who is the owner of that stock and it's now time to vote, every individual who has ownership is identified and they can vote their own shares.
Is this the end of mutual funds?
I think, well, a lot of people, it's a wrapper. It's not the end of it, but I would say the dominant form of bringing products going forward will be in the form of ETFs.
The current system is digital, but it's still slow. It's batch-based, it's permissioned, and it's friction-heavy. Think about settlement times and delay times. But markets move in milliseconds, even quicker sometimes. But settlement is still behaving like it's 1995. So what they're selling to you is this: efficiency, faster settlement, unlocking liquidity. But underneath that is the actual true story. Because when settlement becomes tokenized and programmable, the system becomes centralized in an entirely new way. It becomes centralized and programmable by code. And code never cares about how you feel. If this is efficiency for efficiency's sake, then why is it being built by the biggest institutions that hold and custody our money, our pensions, our portfolios? Here's the mental anchor you need to think about. If you hold a $100 bill in your hand, it's simple. You possess it, you control it, you can use it. Heck, you can burn it if you want, right? I know, sacrilege to many. But for most people, we don't live in that world anymore. Your paycheck hits direct deposit. Your money comes as a number on a screen, and you're told that's your money. There you go, mate. But technically, it really isn't when you think about it. It's a liability at the bank, a claim on the bank, a promise written within a ledger held by a bank. That's why the FDIC exists in the United States and the FCSA, or whatever it's called, in the United Kingdom. Because without insurance, the truth was brutal. If the bank fails, your money becomes a court process. And here's the part most people actually don't like hearing. Money going digital doesn't just make things convenient, it makes custody invisible. So you stopped noticing the trade, you gave up the possession, you gave up the ownership, all for access. And now, tokenization, that takes it one step further. And it doesn't just digitize your claim, it standardizes it into programmable debt. If your money is safe, why do they need insurance limits at all? What does tokenization really mean, and why are they all jumping on the bandwagon now? Because people hear tokenization and they think it's just a buzzword. So let's actually make it physical.
When we bought BGI, we had $290 billion of ETFs. Today we have $3.5 trillion. And then this week alone, just yesterday, we launched the iShares Bitcoin ETF. And so I would say to you, if we could ETF a Bitcoin, imagine what we could do with all financial instruments.
You know, it's cheap, it's fast. So we've always been using technology to do a better job for the client. And we're going to do the same thing in tokenization. So tokenization, blockchain is real. It's been around for quite a while, but now it's becoming more effective, more efficient, because people are finding ways to do it faster and cheaper, permissioned or not permissioned. Smart contracts, I think, will probably be real. We're working on stable coin, and a JP Morgan. We have a JP Morgan deposit already, and think of it as a token, which is a deposit. We can pay interest on it. And as a payment system and a network, we're involved. If we can use things like that to do something better, faster, cheaper for clients, we're going to. And it's just kind of the next generation of things that might do that.
And that means every stock, every bond will have its own, basically, CUSIP. It'll be on one general ledger. Every investor, you and I, will have our own number, our own identification. We could rid ourselves of all issues around illicit activities around bonds and stocks and digital by having a tokenization. But the most importantly thing,
a token is simple on the surface of things. It's a thing that represents another thing, almost like a derivative of a thing. Arcade tokens, they represented prizes back when I was a child. Casino chips, they represent dollars. Old paper currencies, they represented a claim on gold. Good luck getting to that nowadays. But here comes the history lesson about Nixon and how he broke all of that. Because when the US finally moved up the gold standard, it stopped being a claim on anything physical. It became a pure fiat currency. Value because they said it had value. That was the major abstraction. Money stopped being a claim on value and it became a claim on trust. Now, tokenization is the next abstraction. Digital money exists in those bank ledgers. Tokenized money exists on those banks' rails. And the marketing line is, it's faster, it's cheaper, it's more efficient, but the system level reality actually is tokenization turns money into software, and software means rules. Software means programmability, and rules mean conditional access, programmable settlement, programmable permissions. That's the real change in the system, not the digital, it's the code, it's the programmability of the code.
But it's going to take time for everyone to be comfortable with it. So that's why we're pursuing multiple angles. We did want to be the first to tokenize OpenAI and SpaceX. And I don't know if there will be a Guinness Book of World Records for that one, but there should be. But what we're doing now is we're working very closely with companies and making sure that they welcome the tokenization. They see
Because who guards the guardians? Who gatekeeps the gatekeepers? When money becomes software, who writes the rules? It's the institutions. Here's why this isn't a small experiment anymore. BNY Mellon, JP Morgan, Goldman Sachs, they're not just random banks. They're custodial banks. And that means one thing. That means they sit behind the scenes holding the largest assets, maintaining the records and making settlement for the biggest players out there. The number you should always remember is this. BNY Mellon has about $57 trillion in assets under custody today. That's not assets owned, that's assets controlled in their financial system, in their plumbing. They also clear something like 2.5 trillion per day. So when that institution starts offering tokenized assets, you need to pay attention. This is moving from theory to actual plumbing, because the custodians and the clearinghouses aren't the flashy part of finance. They're the part that decides what is real and who owns what. They decide what is settled, they decide what is final, they decide what's valid, and the record of ownership, so who actually owns it, where the proprietorship is actually held. So tokenized deposits, it's not crypto, it's not stable coins. They are the old system upgrading its settlement layer. If this is harmless progress, why are the biggest custodians the first movers and not the regular people? Let's connect the dots. Okay, so the cash gets tokenized. The deposits get tokenized, the securities get tokenized, hell, your house gets tokenized. And the end game is obvious, right? One unified settlement environment where cash moves, securities move, settlement is instantaneous, collateral is completely optimized. Everything down to your house, your car, your assets are all programmable. This is why institutions absolutely love the idea and really want it. Because today, settlement delays force firms to park cash. It's unmovable, it's unproductive, it's illiquid, post extra collateral and take counterparty risk, all of those things, and it costs money. Tokenization sells the dream, no friction, no delay, no settlement risk. And on paper, that is actually the truth. Because here's the trade, the more efficient the rail, the more centralized the control of the rail, and the more the system ends up actually depending on the rail. So you get a world where the market isn't a place anymore. It's a permissioned network now.
This is a big market. Just to show you what one study shows is that real world assets, the market cap for real world assets is expected to go from 600 billion this year to about 19 trillion in 2033. And we're not just talking about equities, we're also, of course, talking about bonds, gold, real estate, any type of real world asset that you can think of. Now,
if the whole system runs on just one rail, what happens when you're not allowed on the rail? What happens when you're not allowed aboard or on top of the rail? Here's the uncomfortable truth part of it all. Tokenized money can make things faster. I'm not going to lie about that. I don't claim to know everything, I never do. It can also reduce settlement friction, for sure. It can improve liquidity functions and efficiency. That's definitely part of the sales pitch. But it also creates a world, a Machiavellian world, an obscured world where transactions can be tracked by default, evaluated by rules, programmatically blocked, and it doesn't need a dramatic dictatorship to do any of it. It just needs compliance rules, systematic control, risk rules, policy rules, misinformation rules, or I don't know, a social credit score that says that you're not being a very good boy or a good girl, a sanction list, a safety list. All of these things allow programmatical money to be incredibly dangerous and powerful in the wrong hands. And once you build that system out, it doesn't matter what the original intention ever was. It metastasizes, it coalesces around vested interests, because systems always get repurposed. That's the nature of the power embedded within them. They never tell you things like this. We're building a system where money is conditional. They say we're improving the settlement. We're making it frictionless. We're making it more transparent. We're improving the speed of it all. But the ability to make money move fast is the same ability to decide whether it actually moves at all. If it's really all about speed, if that's really the true machination of it? Why does it require more surveillance, more intermediaries than ever before? But what does this actually mean for the average person? When you think,
why would you want tokenized equities? What is the benefit of them? Well, they can be more easily traded. There's faster settlement times. They can be split into smaller pieces, so you have more investors that are able to access these. They can be accessed from anywhere in the world, and they can also be used as collateral. I mean, I had one industry insider telling me you'll be able to even swap. Let's say you want to dump Alphabet and buy Tesla. You'll be able to do that in one move. You won't have to sell one, wait for the settlement, and then buy the other one. The goal is to eventually have stocks like Tesla, like Amazon, like the Mag 7, all issuing, those companies issuing their shares on blockchain. The challenges, of course, are that you have settlement processes that have to be changed, clearing processes that have to be changed. These are processes that can take days as far as settlement time.
to refine and distill and titrate a very complicated subject into a few sound bites is difficult, but you are being moved from one system to another, ownership to claims to programmable access. And the more that happens, the more your financial life depends on institutions, the clearing rails, being a good boy, being a good girl, your custodians that you don't elect or that you don't know, the rules that you never control or write. So what do you actually do with that? You don't panic, you don't LARP, you do what serious people do when systems actually change. You understand the rules early, because in every monetary transition, insiders get positioned first. They always do. Holders get educated last. That always happens as well. And the public gets the marketing version. The institutions get the real version, and they front run the price always. And when the transition accelerates, it will not feel like a reset. It's going to feel like a punch to the face. Convenience, better apps, cheaper discounts, more efficient movements of money, quicker movements of money, remittances that are borderless, faster transfers, less friction, safety, protection. All of these buzzwords are going to be alongside the marketing campaign, which comes along with this tokenization of absolutely everything, because that's how the system always controls and sells itself. If the system is actually truly built for your benefit, why do you always find out last? And why can you never invest or benefit from it first? So no, this isn't just about crypto or about faster payments or about remittances. This is the custody layer modernizing into a programmable settlement layer. That's why JP Morgan are talking about it. That's why Jamie Dimon are talking about it. It can make capital more efficient, 100%, sure it can. And yes, it can also build the infrastructure for conditional money. Of course it can. That's the real trade though. Now tell me what you think, because I might be overacting. I've been accused of it before. I might be missing something. I've definitely been accused of that before. Or this could be exactly how financial reset actually looks, quietly and through plumbing. Drop your views in the comments on what you think. And if you want more of this, money, markets, liquidity, and the mechanics behind the headlines, then be sure to subscribe, because the next decade won't be explained on mainstream TV. It will be explained through the plumbing.